Yeah, so I sort of see the markets being pulled by two big forces. On one hand, like you say, the spread of COVID, the flare-up that we're getting in the United States, but also other parts of the world. And that's very important. That's sort of like the potential. And then the other side of it that the market's being pulled by is the central banks are providing a lot of liquidity. They're still printing a lot of money. In fact, the ECB's balance sheet jumped by almost 10% last week as it sort of made those loans over €1 trillion worth of loans at minus 100 basis points. So we're still seeing the central banks provide liquidity, governments providing more fiscal support, and I think that this is the two sort of horns of the dilemma the market faces. On one hand, the COVID, the flare-up, we've had some better than expected economic data, but the market already more or less priced that in, that we've seen the worst in March or April, and things would get better in May and June, and that's the economic data is confirming that. And on the other hand, you've got the COVID, which seems to be having an economic impact. I see Apple is going to close some more stores, and I want to say that roughly half the states at least are either stalling the opening up process or even reversing it. But I think that the markets are still looking forward to a Q3 for Europe and for the United States and for China that will likely be positive growth. Look at the PMIs, the Purchasing Manager Indexes that have come out in recent days. China only saw a negative reading in February. That is below 50 in February. Otherwise, the composite has been above the 50 boom-bust level. The U.S. the U.S. data is coming back, and I think it's really a question of a relative speed and whether the U.S. can contain these flare-ups. And so, but I do think that we're seeing economic data that suggests that the worst of the economy is behind the U.S. in the second quarter, where the economy might have contracted at an annualized pace of between, say, 35% and 45%. How much the central bank's liquidity is giving speculators and risk takers like the wherewithal to make their wagers, and then what are they wagering on? And I think you see this, the NASDAQ, for example, in the U.S., positive for the year. The Shenzhen market in China, positive for the year. The Kospi, like the NASDAQ, the KOSDAQ as we call it, so the over-the-counter market in Korea is positive for the year. So that tells me that marginal speculative dollar, those momentum traders, want to stay with the high-tech space. And that's why I think that those markets are really picking up smaller, more dynamic companies that are tied to the new technologies. The overnight unsecured rate in the Eurozone fell to record lows. The U.S. Fed funds, sort of the equivalent, that Fed funds rate has actually crept up a couple of basis points. We're talking about very small movement, but in the short run, I think that what you're getting at is that when investors want to take risk, they sell the dollar, because almost every other asset besides the U.S. dollar, T-bills, or the cash equivalent, if you will, are seen by investors to be riskier. And so when people feel comfortable, I think when things are going well in this environment, people want to sell the dollar. And I think that it still hasn't really broken out, though it is the dollar is trading at lower levels than it was earlier, say in the crisis back in March, where it really rallied on the panic. But I'm expecting the dollar to gradually weaken in the second half of the year as people focus once again on the sort of what we call the twin deficits. Both the magnitude of the budget deficit, and July is going to be an important month because some of our benefits, like the $600 a week in extra unemployment compensation, that's supposed to expire at the end of July. And now it's really up to Congress whether they can extend it, and can they extend it in enough time. And so we should be getting some fiscal policy initiatives from the U.S. as well as the EU here in July, announcements at least, if not the actual spending. But I do think that in general, people will still have this risk appetite, and this will weigh on the dollar as we focus on that twin deficits, budget deficit and trade deficit.